Okay, good stuff. You can people extra 2 minutes to come in there, so we'll just kick on. We'll kick off. Okay, folks, welcome along to our mortgage switching advice presentation hosted by myself and Ryan Flood. We'll introduce us properly on the next slide. Essentially, guys, what we're going to try and do today is give you a bit of an understanding as to give you an understanding as to, like, why it makes sense to take a look at your mortgage interest rate and why switching might make sense from the point of view of just saving you money, really. I'm going to talk to you about how simple the process can be, because I suppose people can think sometimes the process can be a bit arduous. But we'll see. We'll see as we go through the presentation. Ryan is going to give us a good understanding as to what it takes and what you need to do from the paperwork point of view on that, and also give us some examples of the savings that can be made by switching mortgages. So I'll click on to the next slide. So just to introduce ourselves. So my name is Colin Whelan. I'm a certified financial planner. I've been with the company for roughly about 11 years now. And I'm joined by my colleague, Ryan Flood, who is our in-house resident mortgage advisor. Ryan has a background in mortgage underwriting and has previously worked for the likes of Bank of Ireland and their mortgages team. So we're delighted to have Ryan as part of our Irish Pension Finance group. And he's adding value to our client base by being able to give our clients best advice when it comes to mortgages, whether it be a first-time buyer, whether it be a person with a mortgage already. Ryan is our go-to guy, our guru, if you want to put it that way. For those of you who aren't familiar with Irish Pension Finance, okay, we're an Irish-owned brokerage. Okay, very proud of that fact. We've been in business since roughly the mid-90s. And I suppose the reason that we have have such a broad client base, as you see there, we've got over 30,000 clients, is because we have our public sector group additional voluntary contribution schemes in place. So from a financial planning point of view, we try to tick all of the boxes, and hence why we're doing this Switchers Mortgage webinar today. Very proud to have over €1 billion funds under management, and we believe that goes to show there's a level of trust placed in us by our clients. And that's why we try to be first in class when it comes to the advice that we give. Okay. So we are also very proud of our Trustpilot reviews. We have extremely good Trustpilot reviews. We've only started doing that in the last number of years. 415 reviews, we have a score of 4.8. Okay, so we're proud. We want that to be 5.0. So we're working on trying to get that as high as possible at the moment. Just to state, I'm going to hand over to Ryan. I'm going to go through the agenda now in a second or two. But before I do that, I want to just let you know that there is a prize draw today. Okay, so we will be asking you a question. Okay, we will be asking you a question at the end of the presentation, and we will be using the questions and answers box. We won't be opening up any chat. We'll be using the questions and answers box to choose the winner from. Okay, just to be clear on that for everybody. And with that in mind, we also have the question and answers box as well. If you have any questions that are going like that, if Ryan's going through something and you have a question that you want us to address, ask the question. What I'll do is I'll be emceeing, if you want to put it that way, and I'll stop Ryan where I feel makes sense, and ask Ryan the question that you guys are asking us. It's important that you get as much from today as possible, from an information point of view, to give you the information that allows for you to make an educated decision on whether or not you believe it's worth your while in looking into switching mortgages either now or in the future. Okay. So you see here, the agenda is going to be why choose a mortgage broker. Okay, why should you review your mortgage? What is the mortgage process? Okay, what's the process from a switcher's point of view? What documentation is required? What are the rules and the fees associated with doing this? Okay, what are the benefits? Okay, there has to be benefits. If there are no benefits, why would you do it? And as I mentioned earlier on, we'll do the prize draw as well. Okay, and then from there, then Ryan will tell you kind of what happens next if it is something that you want to avail of a consultation. Okay, Ryan, I'm going to hand over to yourself.
Sure. Thanks for that, Colin.
Ryan, I'll give you the control of the presentation.
Yeah. Okay, so the first thing we're kind of going to touch on is why public sector staff choose IPF. So as Colin mentioned, we do a lot in terms of public sector schemes, and as you're seeing, we have a high number of clients. So with them and that comes experience in the public sector. We understand how the roles in public sector work. We understand how your income works, because it is a little bit different to your standard employee. All the different benefits you have aside from that will be in relation to your superannuation. But it also helps us kind of get you a better deal as well. So lender have public sector offerings, whether it's going up your scale, waiving probations, taking different styles of income, all that sort of stuff. So the knowledge of the lenders then comes into that then. So when we're having a consultation, we have 6 lenders at the moment. So we'd have a majority of the market, all the main banks as well. So it just means that we're able to put together the application to kind of best favour you from the public sector point of view. It would work for the private sector as well, but with the public sector, your income works a little bit differently from your base allowances over times, depending on what sort of department you're in. Then access to the lenders, different salary scales. So some lenders will up 1 point up your scale, 2 points, all of that. It doesn't really matter much from the switching perspective because the loan's already there. It would only be if you were looking for additional lending, that's when that would come into it. But it's more just understanding how your income works. Obviously makes it easier for us to put a plan in place for you, whether it's from financial planning, mortgages, whichever.
Just on that then, Ryan. So what you're saying is right that we can actually, because we're public sector experts, we actually understand exactly what we can try and do to get like people in the public sector a bigger mortgage, if that makes sense, or a bigger loan amount from the lenders. Is that basically what you were getting at there?
It could be a combination of a bigger loan or a better deal. So like we're able to kind
Okay.
of change the loan amounts in relation to the type of mortgage they're doing, if they're looking at extending the mortgage over a longer term. As public sector, you do have very strong pension benefits. So that will come into it then as well. So there's a number of different aspects where being public sector is quite helpful. A lot of people would be in a role that we would have kind of dealt with before as well. So we have experience with that person, that department, that sector to make it kind of a bit smoother of a process.
Okay, good stuff.
Sure. So the next thing that we look at is why should you review your mortgage? And the first one is the main reason, more or less, save money. Nobody wants to pay more for something if they can get it cheaper elsewhere. The way the mortgage works is that it's essentially just a loan on your property. Regardless who that's with, that's all it kind of is. So why should you overpay when there's a better option there? The main reason why you should review it as well is there's been 7 consecutive rate cuts by the ECB. So we all know in 2021, Ireland had one of the higher rates on mortgages in Europe. 2022 comes along, the rates start to go up. 2023, there was a large jump in mortgage rates. So they shot up over 4.5%. And then obviously then last year they started to come down, and then this year you're seeing the biggest benefit. So there's been 7 consecutive cuts, all of which have brought it down, but quite a bit. So you want to make sure the product you have, the mortgage you have, like if you locked in over the last 18 months, you could be on a high rate compared to now. If you locked in 5 years ago, you could be on a really low rate coming into a higher rate. So you want to make sure that your mortgage is in the best place. That'll be able to kind of make you save money more than anything else. And the increased competition with people like Avant, there's a new lender now, Nua. There's a number of different lenders now on the mortgage side of things that the more competition, the better, because it just means they're all going to be fighting reducing the rates, but also have different offerings then as well in terms of how they lend, what they lend for, and incentives then that they have, like cashback and such.
Yeah, that's great, really, isn't it? The increased competition, because we've had banks exit the market over the last number of years. So it's great to get these new lenders come in and just actually drive down lending rates across the board, Ryan. Would that make sense?
Yeah, and different types of products as well, which helps. So it's kind of
Yeah.
increasing the competition, increasing the product selection, and increasing your choice. But it also
Yeah.
means they're going to work that a little bit harder for you, whether it's from a customer service perspective, because they want to obviously retain business.
Yeah, and like I suppose another thing I picked up on there was like you mentioned about the rate cuts and that, so 7 rate cuts. Do you have any examples of kind of what that's looked like throughout the years?
Well, the lowest rate we had before the rate started increase was around 1.95.
Okay.
A lot of people who would have fixed around then would have been around 2021. So you're looking at 3 to 5 year fix is usually what people go for, especially first time buyers, because it's new. They just want to guarantee what it is. If you've drawn down on 2% and you're coming off your fixed term in the next couple of months, your rate is going up by probably 1% at least.
Okay.
It might not sound like much, but it could be different with €400 per month, 2 to 400. It's quite a big jump. And if your finances aren't in order, or you're not sure if you could take that hit, what's going to happen then? You don't want to be putting yourself in a position where you're struggling or just kind of living month to month paying the mortgage and that's it. You obviously want to make sure that what your mortgage is doing is working for you as well. And then on the flip side of it, the rates are potentially lower now than what they were, let's say, 2 years ago. So if you fixed 2 years ago for a 3-year fix, just to begin with, you're coming off from, you're currently on probably 4.5%, maybe 4, depending on what type of mortgage you got. So there is savings then as well on the flip side. So it's kind of having a review of it, making sure that it's kind of set up correctly for you.
Okay, very good. Okay, so like I think like it's post-COVID, really, it was a post-COVID, right? We had a spike in rates, inflation was going through the roof, interest rates had to go up, and we had a
Yeah,
massive spike in rates, as you said there, with the but since then, obviously, we have these rate reductions, which is what you're saying will actually hopefully help people from a mortgage repayment process.
yeah,
And I am one of those people as well, just to be clear with that.
yeah.
Um,
So rate cuts are always welcome.
yeah, absolutely. Yeah, absolutely.
Yeah, it just gives you more money in your pocket. Yeah, move on. So this is just like a little quick example of a case that I've had recently enough. So these clients came to me, they took out the mortgage 5 years ago. So it was roughly around 250,000 left. So they had about 30 years left. 3.5% was probably what you're looking at back then about 5 years ago for a 5-year fixed. So repayments about 1122. So what they did is they came to me because the loan to value kind of reduced because how high price values are going for houses as well. So that's another element to consider. So
Mm,
they're able to get a 3% rate, which is phenomenal when you consider what type of market we're in at the moment. They're saving €68 per month. But the main point to that is that 0.5% means there's just under 25,000 in interest savings, which is very, very high. But what we did in this scenario was they were onto a colleague of mine in relation to the ABC who referred them to me from the mortgage point of view. The mortgage is the priority, so we looked after that. But what happened is they touched base down with that advisor because they hadn't got a pension set up. They had their ASC through public sector, but obviously because they joined late, they weren't able to kind of get the full benefit. So they decided to go down the ABC route. Obviously
yeah.
increases it. Again, this is just an example. Like the €68 can go into your pocket, go into savings, it can go into day-to-day spending. But in this scenario, they just put it into their ABC. And they've not only saved 25,000, they've also given themselves a pension pot of over 90. So it shows that it's the exact same thing they were doing last year, except now they have all these different benefits basically from it.
Yeah, it's quite a busy slide, but I think like the main message I take from that then is like even with a small like 0.5% decrease in your mortgage interest rate, you can I mean you can make considerable savings. And
Yeah,
I suppose then like we've given an example here of like how you could utilize those monies towards building a pension pot for yourself. But obviously those monies can be used for maybe going on a holiday or doing something nice as well, or split them like half towards the ABC and half towards something nice, or even reducing the term in your mortgage as well. I think maybe we might talk about later on. But I suppose what we're trying to illustrate here, Ryan, is really that it's money in your pocket and not in the bank's pocket. It's
yeah.
dead money going into the bank, and if you actually if you have it in your pocket, well then you have choice, you have options, really, isn't that correct?
The main thing is to have the option. So like if you have the money in your account, you can pick and choose what you do with it.
Yeah.
But you get to choose rather than just have to pay the mortgage. So that's kind of the main point on that slide. Again,
Mm,
it's more just kind of illustrative to show you. In terms of the potential benefits as mentioned, like we're able to review the market, get your best terms. And what I mean by that is that you might be looking to do something else other than switch your mortgage. You might be looking to extend your term, reduce the term, go variable, go for fixed rates. It depends on what you want to do, but we're able to review the market and get the best deal for you. The rate types available. So like there's a whole rate of rates available, whether you're looking for a variable rate, long-term rates, kind of flexible rates that are kind of keeping up with the market. If you're looking to top up your mortgage, equity, release equity is another term for that, is essentially just take money out, put it on your loan against the value of the property, but those monies can be used for a number of different things. If you're looking to reduce your term cost of interest, that's an option. And then you have your cashback options. So the cashback
mm,
option is a big one, especially if your balance is 250 plus, because that'll cover all the costs to switching. It'll also mean there's additional funds going back to you as well. So you're actually getting paid to switch your mortgage. Sounds silly, but the bank is giving you money to make you pay less for your mortgage.
mm. I
Crazy
can
enough.
actually, I can speak to that. I can speak to that actually. So like a
Yeah,
number of years ago, Ryan, I would have done a switch on my mortgage, and I took a look at the interest rates available and the cashback options, and I set up on a 3-year fixed one of our providers, and they gave me back 2%, and it not only covered my legal bills, but it also paid for my front room to be done up, which my wife was absolutely delighted with. But in saying that, right, so like I'm gonna look again in a few years' time and see what I can do then to try and actually see if I can lower my rate again, see if we can get a cashback option. Hopefully this time spend it on something nice, or put it towards my pension, whatever it might be, right? But you have options with those monies, and I really think like the key word there is options. And utilizing the monies that utilizing the different products that are available to you to try and actually drive down the cost of your mortgage, but also then to maybe give yourself, that few quid in your back pocket as well.
Yeah, as you said, options. I
Yeah.
know I'm gonna probably constantly repeat myself, but it's always better to choose to do something than
Mm.
not. This slide is essentially just all the different things you can release equity for. So if you're looking to do home improvements, whether you're let's say new child on the way, family's getting bigger, you want an extension to the property, you can top up your mortgage and do that. So you can top up with your existing lender, or you switch and get the monies, whatever kind of works for you. You could consolidate short-term debt. So if you have any loans, let's say you have 4 or 5 small loans, you used all that for home improvements or whatever you used them for, will determine who you can go to. But there's the option of putting that in on your mortgage, reducing your day-to-day costs. Obviously, with the cost of living, that's a big impact on people as well. So just making sure that you're able to function correctly. Education and medical expenses. So these are two that you might not expect to come up, but they're quite important because we all know third level education is not cheap, especially it just keeps growing, growing, growing. Medical expenses is just something that's going to come out of nowhere. So if you don't expect something to happen, you're not going to be prepared for it. So in this case, you can use the property that you have, the equity you build up to kind of cover that. If you've got a gift to buy the house that you're in, so let's say your parents or a family member helped you with a gift, you want to pay them back, you don't have the funds on savings, you can release the equity in the property if you can afford it for the lender. You can repay the first home scheme. So this is quite common nowadays because everybody's using whatever they can to get a property, depending on where you're looking to buy, especially on new builds, they're quite expensive. So if you use the first home scheme to do that, and again, numbers wise, it works, you can top up your mortgage to repay that off. So at least the mortgage is just in one balance. You don't have to worry about additional fees, costs, and so on. And then the final one's in relation to like your divorce separation cases where you buy a house together, you want to buy their interest out, you can release the equity in the property to buy their interest out and you become the full owner of the property. So it just helps clean all that up and just make it easier for you to kind of keep tipping away.
Not the nicest, not the nice point there in the last point, really, is it? But yeah,
It's not, but it's realistic.
Yeah, yeah,
Unfortunately, it is one of those where it is a high rate that
mm,
happens,
yeah,
and it's at least you know there's something there for you to help,
yeah,
and you don't have to worry about going through court for the next 5, 10 years.
yeah. That'd be nice. Hopefully, you never get to that point. But anyway, if you do, you do. I think like
Yeah,
there's a question that's come in from one of our attendees. There's a few questions coming in actually from our attendees, which is
sure.
great. And I think you touched upon this, but like, just read this out. Is it possible to fold in a credit union loan to a mortgage if a person switches? Okay, and also if they're looking to release equity in order to renovate, is it possible to fold in an existing home improvement loan? I think that's kind of the same question, but you might know better than me.
Yeah, so you can do both. So when you
Okay.
release equity, you just release money, but depending on what you're doing will determine if the lender will do it. So what I mean by that is most mainstream banks would only do it for the main points in terms of gifts, the education, and medical expenses. If you're doing home improvements to the house and you're consolidating debt, that's fine. They'll have their
Okay.
own different rules on it, but it have to be kind of home improvement related. So it couldn't be a case that you have 2 car loans and a credit card and you want to consolidate them in. They wouldn't look at that. But what they will do
Okay.
is they will look at the loan if it's home improvements. So it
Okay.
was used to work on the house. You can add that in. You can release equity at the same time as well. So you can do a bit of
Okay.
both. So let's say you done work to the house 5 years ago, you have 5 years left on a 10-year loan you got with the credit union, and you want to do additional works again. It's possible, yeah. Again,
Okay.
it's
Great.
all based on a case by case basis.
Talk to your advisor. That's kind of the motto.
Essentially, yeah. So I can run
Okay.
through all the different scenarios. If you do this, if you do that, 2 or 3 different scenarios can kind of pop them in an email to you, and you'll be able to review that then, obviously, to see if it is something you want to do.
Okay. Cool. Okay. Thanks, Ryan.
Yeah. In terms of the mortgage journey, it's a little bit simpler. Yes, it's another mortgage application. So it's very similar to when you got the house originally, but there's no stress of trying to find a house. There's no stress of trying to close in certain timeframes. It's a little bit more relaxed because you have the house. So it's essentially you complete your application, you get your approval. You're probably looking around 10 working days to get an approval once the application's submitted. Once the approval comes in, there's 2 different ways you can do it. You can do a straight to approval or you can go straight to your offer, whichever one you prefer. And at that stage, that's when you get your valuation. So you still have to get valuation of the property, even if you only done it last year, 2 years ago, 10 years ago, you're still required to have a valuation and a BER cert if you have one. Once evaluation is done, we then move to the completion stage. So the valuation probably take a couple of days to do, a day or two then into the lender, and then you get to the completion stage. So I've had switching cases that have finished in 4 weeks. So like switching cases that took a year. It just depends on the person and what they're looking to do and how quick they wanted to move. Perfect. So in terms of fees involved, so from the valuation fee, you're probably looking around 150 to 200. From legal fees, it's usually between 1,500 to 2,000. You can get it cheaper. It just depends who you use. They all do the same thing. So it's one of those where you just pick and choose. You can shop around. Are you changing?
Not meant to be. I think we might have skipped a few slides there. We're going to go back maybe on to slide 9. Apologies, folks.
Yeah.
There's quite a few questions coming in, so I'm actually trying to go through the questions. So, you should have
pull it
to,
back,
you should have,
it's not letting me.
is it me? This you are
Yeah.
controlling it. Okay, sorry guys, some technical issues. So just bear with us. If you stop moving your mouse around, I'll try and move mine. It's a bit
Yeah.
strange. I think
There we go.
we skipped that one, I think, didn't we? Do you want to see if that works for you there?
Yeah, sure.
Is it
No,
working?
not
No.
letting me.
Okay, give me a sec. I'll just go back up to you stop moving there and I'll go back up into
Yeah,
Zoom.
sure.
It says that you have control, but obviously not. Okay, so just bear me a sec here.
Yeah, sure.
Sorry,
I'll
folks.
go through the documents anyway, while it's on it. So in terms of documents, it's the same as your initial mortgage. So it's 6 months current accounts, 6 months savings, salary certs, pay slips, and your employee details summary. So that's just your P60. Proof of address and ID, which is common with every application, and then case specific documents. So that could be marriage cert, residency permit. If you're looking to release equity, then obviously they'll look for what you're looking to do. Works, quotes, invoices. If you're consolidating a loan in previously, they'll look for your loan statement and so on. So it's all very dependent. Some lenders have reduced requirements. So some lenders won't need a salary cert, they just want pay slips because you're switching if it's a straight switch. If you're looking for additional lending, then obviously they'll look for additional documents. But it's pretty straightforward, but it's very specific to each case, because everybody's a little bit different, even if it's the same.
I think it's important on this slide, right? Because I think it's one thing saving money, but the hassle, everyone, as I said to people earlier on, I've switched mortgage myself, and it actually worked out very, very well for me. But I think some people might be afraid of the hassle of doing this, right, and actually going to all the paperwork and getting everything together. But can you tell people what we do to try and help out with that process?
Yeah, so we try and streamline it and make it as easy as possible. There's little touch points because it just means the case moves as it goes. So the first thing we do is we send you a link. You sign in to the online platform, you fill in the information, and based on the information you put up, the system generates a document checklist for you. So you don't have to go through, okay, I need this, I need that. It'll actually tell you what you need. There might be the 1 or 2 documents that I might miss out on in terms of quotes and invoices. I won't go into detail because it's just AI. But it'll be able to tell you exactly what you need. From there, the case comes to me, and I'm able to take over then in terms of present the case and get the approvals, get the applications in, and so on. But it's literally log in, upload your documents, and that's it, really. A couple of DocuSigns, again, a couple of clicks on your mouse. All the documents there are very easy to get as well. So like bank statements, you just download an e-statement. Salary cert, you just go onto your employer. In some cases, it's not even required. Pay slips, everybody should get them emailed to them every week, month, or fortnight from their employer. The employee details summary, that's just from Revenue Online. And then proof of ID and address, which everybody would have. And then the case specific documents, everybody will have them based on their own circumstances.
Okay, good stuff. Do you want to try? You see if you can see if the control works for you.
Sure.
Just saying, quite a lot of
There you
questions
go.
coming in. Quite a lot of questions coming in. So I will be asking some questions. I probably won't be able to get to all of them, guys, but I will. I'll ask Ryan a few questions as we get towards the end of the presentation. We're coming towards the end of it quite soon.
Yeah, so in terms of fees, as I said, the valuation and your legal fee, there's no other fees. Any other fees essentially will be confirmed at application stage. So what I mean by that is if you have to get an architect involved, if you're doing large works, if you're getting structural engineering works, if you have to do significant amount of works that requires another evaluation, all that will be done based off the proposal. The main point I'd probably say is that we don't charge you for it. So it's a complimentary service that we do in order to make sure you're getting the kind of right deals, right places. In terms of the financial reviews that we do as well, they're of the same boat. We're more or less doing the review for you, and then it's up to you then to decide on what you want to do. The next slide
Just
then.
just to be clear
Yeah.
on that, I suppose, like from our point of view, right? So like we don't charge a fee for switchers. That's, we don't do that at all. But I suppose, Ryan, what you will do is if someone decides that they would like to actually avail of a consultation with us, we'll do what we call a 5-minute screening call. And we'll just make sure that it's like basically that if we're going to go to, if we're going to go to work and you're going to go to the work, that it makes sense to do so. Is that correct, Ryan? Am I right in saying that?
Yeah.
Yeah. Okay, cool. Great. Yeah. Like just be clear with everyone. So no fee, but we will make sure that we'll make sure it's in everyone's interest to go forward with this. And if it makes sense from that point of view, well then we'll be happy to go forward and try and get you the best deal possible. I
Yeah.
actually just on that
So
one question came in there actually, one which is a very relevant question. Like so, what's the minimum? Because what's the minimum I suppose capital or loan left, if that makes sense, on a mortgage that would make sense to be looking at switching?
it would depend really on what your rate is. So like if you're on a really low rate, it could be any amount that doesn't make a difference because you're not going to save. So in that
Yeah.
case, I'd have a chat with you and say, look, just leave it as it is. You can't get
Okay.
anything better. We're happy out. You're in the
Yeah.
right place. And that's it, essentially, from that side of things. Whereas if somebody's looking, generally, I'd probably say anything 150 plus probably is where you'd actually make a saving that'd be worth it. So
Okay.
like if you switched and you didn't get your legal fees covered with cashback, you want to make sure you're saving money as well. There's no point saving €20 per month
Yeah.
but paying
Yeah.
€1,500, 2,000 to switch your mortgage. It wouldn't make sense then.
And when you say
On the other
switch to
perspective.
mortgage, that cost actually, another question actually came in on that is just in relation
Hmm.
to the solicitor fees, really, isn't it? So you're just actually,
Yeah.
because it's going to cost between 1,500 and 2,000 approximately for the solicitor fees in relation to this type of
Plus your
transaction.
valuation.
Okay.
Plus your valuation. So you're probably talking between 1,700 to 2,200 to switch
Okay.
your mortgage. Again,
Okay.
it's very dependent on the legal fees. The cheaper you get them, the better.
Yeah.
But the main thing to kind of think of is, am I making a saving? You could be saving €50 per month. It's still only €600 for the year. So if you're paying €2,000 and you're only saving, let's say, 1,200 over the 2 years, it's not really worth it, is it? So that's kind of what I run through as well. Is even though yes, you might get a cheaper rate, just it doesn't mean you're going to save money to switch as well. So sometimes it's better to go to your existing lender and say, look, what can you do for me? They might
Yeah,
be
and
able to help.
that's it. Like we have to make sure that everything we do is makes sense. I mean, that's the key part of it here. We come up as from my point of view as being a financial planner, I try to come up with solutions for my clients that make sense. I think that's what you're alluding to there, Ron. So that makes a lot of sense.
Yeah. Exactly. So there's a couple of points that I generally kind of recommend as well with switchers. So like there's a few things to review after you get your approval. So it's still the same as the initial mortgage where mortgage protection is mandatory, so is home insurance. If you change anything on your mortgage protection might not be the same. So if you've topped up your mortgage in the meantime and you didn't get updated life cover or anything like that, you might not have sufficient cover. So you might have to review that again. If you're looking to release money, then obviously you have to increase that anyway. Home insurance is a big one, just with the cost of living, the cost of goods, everything increasing at a very high percentage in terms of inflation, cost of goods. Your house is probably costs more to rebuild, which is what you have to insure for. So it's making sure that the insurance is still lining up, because if you underinsure, if you ever claim, you're never getting the money fully. So again, it's looking out for what's right for you as well to make sure that's still there, as well as that it's still required for the mortgage. Contents insurance, again, it's not mandatory, but a lot of people don't have it. And it's quite important because your possessions are valuable, whether it's financially valuable, whether it's sentimental. Like your goods are worth something. So it's obviously something to look at as well, especially if there's damage. And then the income protection piece, I think you're probably more placed to discuss that. Would you be, Colleen?
Yeah, so I suppose like for me, this is if basically if you don't have your income, I think it might be fair to say that you don't have much, kind of way. And I think a lot
Yeah.
of people go to making sure you're forced to insure your car, but the contents insurance, you insure contents, et cetera, house insurance, all your car insurance, all that type of thing. But really what actually pays for all those is your income. And I think the basis of any strong financial plan, the foundation to any financial plan is actually having some form of income protection in place. And recently, what we've done, IPF, we've actually released our Family Protect package, which actually gives a bit of life cover, a bit of serious illness, and also a form of income protection as well that we've recently launched in Irish Pension Finance, because we believe that there's a need for that type of product. So I mean, like, that's something that we recommend to anybody who's taking out a mortgage, anybody who's got kids, anybody who's got loans, debts that would need to be serviced. And if there was something that unfortunately you weren't able to work due to illness or injury, a policy like this, for want of a better phrase, can be a bit of a lifesaver. So it's something that I'm very strong on from a financial planning point of view with my clients, and I hope people understand why.
Yeah, that makes sense. Protect your biggest asset, as they say. So the question essentially now is just for the prize draw. So I'll kind of leave this here for a couple of minutes if you want to try and start throwing your answers in. This was mentioned there throughout the presentation. So it's essentially how many rate reductions have there been by the ECB since they started reducing?
The chat box isn't open, but the questions and answers area is. So please use the questions and answer area, and we'll pick a winner now. And we'll give you 60. We'll give you 20 seconds.
Do I go through a few questions there, Colin, in the meantime?
Yeah, I think that might be a good idea. So give me 2 seconds here. I mean, like, a good few questions are coming in relation to, I suppose, when would be a good time to actually, like, if you're coming, like, when should you look at this, Ryan? If you're looking at, you're coming to the end of your fixed rate, at what point in time should you start looking actually to see what's available on the market?
If you're just looking to switch straightly and you're not looking to release any funds, 6 months is more than enough time.
Okay.
Because what that'll allow you to do is to get your ducks in a row.
Mm.
So you're able to know, okay, I need to do this, need to do that. You still need to show in some aspects in terms of account conduct and so on. It's not majorly important, but it's not ideal if it's misdirect debits, missed payments, all that sort of stuff. So we can have a consult and we go through the options. You can also see 6 months out, okay, is it worth switching? If not, then you can start reviewing what other options you have, whether you want to stay with your same lender or if you want to make overpayments to bring it down to reduce payments, all that sort of stuff. If you're looking to release funds, generally anything from whenever you need to, it comes up, because whatever plans you have in place might not have time to wait another year, 18 months. If you have a kid on the way and you want to put an extension in, make more space, you want to kind of do additional garden works, you don't want to wait till winter, because then obviously it'll take longer. It's just with the weather, you can't really work in every condition. So it's small little things like that that kind of play a part in it. So generally what I'd say is pick up the phone, have a chat, do the 5-minute screening call, see what works for you. If something doesn't work now, we can just put something in the diary down for 3 months, 6 months, a year down the line, and then you'll be contacted at that stage to go through it all.
Okay, good stuff. Okay, I picked a winner at random here, and the winner is Shona Keeshan. Shona Keeshan. So well done to Shona. Well done. I'm going to ask a few more questions, but I'll let you get to the end of the slideshow, Ryan, first, if that's okay.
Yeah. So the answer itself was 7. So 7 consecutive rate cuts by the ECB since they started reducing. The next step, is essentially just you can do it a few different ways. So my contact details are available on the website. You can scan the QR code and you can register and you can request a callback. You can fill in the box on the right if you just have a few questions. You can request to have a chat through email, phone call, set up Teams, Zoom call, whichever kind of works. But this recording is still, this webinar is essentially getting recorded as well. So it will be available online in case you missed any sections as well, in case you're stuck in work, couldn't get out a bit earlier. But that's basically it from me.
Okay, good stuff, right? Okay, so just to say, Shona, we will be in touch. So we will be in touch to talk to you about winning about your voucher. So well done. Okay, just a few questions then, right? So this is my question. I hope it makes sense, right? So how does it affect switching or releasing equity if the house is valued higher than when the mortgage was drawn down? I think that's a loan to value type question, isn't it? Really, like, the better loan to
So that'd
value.
be beneficial for you.
Yeah.
So like if you drew down your mortgage and your house is worth 300,000, 10 years later it's worth 400. That means you have 100,000 of equity in it. So generally when you're remortgaging, you can only ever usually go up to 80% of what the house is worth if you're releasing extra money. So in that case, you could go all the way up to 300,000 again in terms of balance. So in that essence, let's say you had 150,000 left, you can release 150,000 or up to, because the value of the house is increasing. You can obviously gear up against it.
Okay.
So it's very beneficial. It's a great position to be in.
Yeah, I think, like, say, another question here was kind of on the same the same mindset was like when remortgaging, is loan to value as important when looking for new deals? And can the loan to value be increased or reduced when releasing equity? I mean,
Yeah, so like if you were looking to switch your mortgage, but you had a lump sum, whether it's from inheritance, savings, bonus and work, whatever the case,
yeah,
and you wanted to say, okay, I'll switch it over there. I want one particular rate, but to get that rate, your loan to value has to be a certain amount. You can make a lump sum payment in between, and you can get the borrowings of whatever's left to kind of cover it. And then that's the original mortgage cleared. The new mortgage draws down at a lower rate, lower repayments, and lower balance.
yeah. A
And
few
it's the
questions
same
coming.
then if
Oh,
you want to
sorry.
release the other way. Sorry.
No, no, you finish. You finish. I didn't mean to interrupt. I rudely
Yeah.
interrupted you.
No, it's more or less, it works the same way as well. So if you're releasing equity, obviously
Yeah,
your rate might increase then because your loan to value is going higher. The reason the rates are higher is it's higher risk because you're closer to the value.
yeah. Okay, cool. I'm with you. Okay. So better loan to value, better rate is what we're saying. Like, yeah. So if we can get your house valued at
Yeah.
a higher amount than what you bought it for, etc., and your loan is lower than what it was when you initially bought the house, or whatever it might be, well, then you'll get a better rate from the lender, is what you're saying. Okay. Like,
Essentially, yeah.
okay, cool. Yeah, right. Okay, so like, and I'm trying to simplify things, but you're probably going, well, actually, there's a few little intricacies to that. Yeah, I get you. Yeah, that's why
Yeah.
you're the expert in this field, and I'm not. Okay, Grant. So, like, and then another question is like, I don't know how this might be hard to answer. Well, actually, I'll ask you two more questions. Okay, so and then we're going to
Yeah.
finish up. So, if you're in a fixed rate for another couple of years, what options do you have to reduce the years, or is there anything you can do maybe to come out of that fixed rate, for example? Is that
Yeah.
possible?
So a fixed rate is just a guarantee of a rate for a period of time. It's an agreement between you and the bank, essentially, like your phone contract, you'll pay X amount for a number of years. If you want to come out of it, you can do, but you could get a breakage fee. So every lender will have their breakage fee available, whether you give them a call, ask what it is, or you can get the calculation through their website and you can do it yourself. It's not that easy to do, unfortunately. I still have fun doing it. So
Okay.
essentially you can work out if it's worth switching. So like I have a case where I actually have a colleague of mine who started questioning it to me because he heard about the switching webinars, doing a bit of work on the
Okay.
slide. So he asked me basically what are my options. So the first thing I said was just get your breakage fee. His breakage fee was about 6,000, which is quite a lot.
Mm,
But the rate he
yeah.
was on was so high because he drew down, I think it was 18, 19, 20 months ago. The rate he can get on a cashback offer, like he can get 2% back cashback. So his
Okay.
mortgage balance, I think, was about 540. So he's
Okay.
getting nearly 11,000 in cashback. That's going to cover the breakage fee. It's going to cover the legal fees. A couple of quid in his pocket. You can use that, let's say, pay a couple of mortgage payments, take a couple of months off to an extent. But he's still saving 150 per month
Oh, so
as
and
well
a
as
better
that.
rate. So not only that, then
Yes.
he's getting the better
So
rate. Okay.
yeah. So it's all about it's all very dependent on what your breakage fee is. That'll be
How,
the make or
how do
break, I
you get
suppose.
how do you get your breakage fee? Like, what do you do?
You get it off the lender. So you just give them a ring and ask. I know it
Okay, so
sounds simple,
simple.
but just pick up the phone. What's my breakage fee? They'll either send you out documents to say
Okay.
this is how you calculate it. They'll post you out what's called a redemption figure because it'll have the breakage
Yeah.
fee on it.
Yeah.
Or you can just pop them an email, whatever's kind of your choice.
In certain scenarios, I believe the breakage fee is nil, is zero. Does that make sense?
It so the breakage fee, if your rate is really low right now, so like
Yeah.
if you're on a 2% rate, your breakage fee is more than likely going to be low or nil because the
Okay.
breakage fee is there to kind of recoup money's lost. So
Okay.
if the rates are really high now, and oh sorry, if the rates are really low now and you're on a high rate,
Yeah.
chances are you have a breakage fee.
Okay.
And
Okay.
it
Cool.
can be quite significant. I've seen some 10, 15,000.
Okay.
So it's
Grant.
very
Okay.
dependent.
I'm keeping an eye on the participants, and we still have the same number of participants here. So obviously the questions are landing quite well, and hopefully people are getting as much from this as what we hoped they would be. But this is going to be the final question. I'm going to let everyone get on with the rest of their day. And I don't know how easy it is for you to answer this question, but
Yeah.
what is the current best variable rate available on the market today? And I know you're going to tell me about loan to values and all this type of thing, but you can just try and give us a simple scenario. I'd really appreciate it.
I'll give you an example then of a case I've done recently. So one of our lenders have what's called a flexible variable. So again, fancy name, but it's a variable rate. It's like a
Mm,
12-month rolling rate. So you get a particular rate. Let's say you draw down now, you're probably looking around 3.01-ish, chops and
okay.
changes. But you're guaranteed that until next September. So come next August, they're going to say, okay, do you want to go again? This is what the rate's going to be. It's up to you to pick and choose. So you get the benefits of kind of following along with what's called the Euribor. and you can get the benefit of any increase or decrease in that time.
What's
Or
your IBOR?
so your IBOR is essentially just the bank's lending rate. So how much it will
Okay.
cost them to borrow.
Okay. So that's
So
so this is this 12-month rolling, just to simplify it again. So this is like
yeah.
every year that this rate can actually go up or down because it's a variable rate,
Well,
obviously.
this rate changes
That's
daily.
how, yeah. Oh, daily. Okay, right. Okay.
So if this particular rate changes daily, the lender chooses to use the 12-month average because it just makes it easier rather than changing a rate every 24 hours.
Yeah.
Does make sense. So what they do is say, okay, we do the 12-month average. We'll change it once a month. But if you draw down your mortgage, you get it for a year. So you get it for the full 12 months. So
Okay,
this
so it's
time
kind of
next
like it's
year,
even though it's a variable, it's fixed for that 12-month period.
yeah. So you're getting a bit of both.
And you have
So
flexibility in repayments because you're not like,
yeah,
you can repay what you want, when you want, how you want. Did you come
well,
into a lump
online
sum?
transfer, but yeah,
Yeah, okay, right. But like, yeah,
yeah.
but yeah, okay. The point is though that there is the flexibility within that variable rate. So it's a really good
Yeah.
rate. It's a really good rate, is what we're saying in comparison to the market today. And then as well as that, then you have the flexibility to be able to throw lump sums off it if you so wish, or
It's
extra
the
money per month.
cheapest variable rate on the market. I think the closest to is probably around 3.75. And
Okay,
that's
so it's a big
obviously if your loan to
difference.
value is very low. So it's a significant difference. You're
Yeah,
seeing what 0.5% done to a mortgage.
yeah,
So that's a lot more. You get the benefit, but like there are other rates then as well. Like if you are getting, let's say you have 10, 15 years left on your mortgage, you just want to kind of forget about it.
yeah.
You can just fix it for that 10, 15 years and you can forget about it. So like you literally go in, get your mortgage and just forget about the benefits of public sector. It'll get easier then to pay it with increments coming in, pay restorations, all that.
Yeah.
So you can have it
Okay.
there in the background and forget about it to an extent.
Okay, great. I think like I'm going to call it there, but I think like the key message is there's lots of different aspects to this that like I can see. I knew this already. To be honest, coming into this presentation, you're an expert in this field. You understand it like true and true.
Yeah.
And I suppose if anyone's wanting to avail of a consultation to look into what their options are, well then take a look at the QR code on the screen there, guys. Take a picture of it and fill out your details, and Ryan will be in touch with you then to have a chat with you and see whether or not it makes sense to go forward or not. Is that fair to say?
Yeah.
All right,
Good.
good stuff. Okay, right, great. Okay, we'll end it there. Thanks everyone for joining us today. Hope you got as much from it as I did. It was pretty good. So look, I wish you all the best. Have a nice lunch. Have a nice day.
All right. Enjoy. Thanks.